start whenever you're ready, and we'll start the time when you begin presenting.
10 years ago, from a small player that no one ever heard of. Now, PTT is ranked as a second place in an oil retail industry. And today, we are here to show you how PTT become a successful company and still continue to be. Good morning, distinguished audience. We have identified a timely investment opportunity, and we are recommending a buy on PTT. Based on the market price as of February 24, 2021, at 18.4 baht, and our target price at 21.75 baht, there is an 18% upside. Evidently, a strong buy based on three major reasons: the solid backbone foundation in our retail, the new frontier of growth in LPG and biodiesel, and superior financial performance reflecting the future prospects.
From its root in oil service stations, PTT has been a pure service station player, which differs from its integrated value chain peers. And its move into Pantai, Massmart, and Omnicare has helped them to diversify its business and receive a higher margin. PTT past success attributed to two main strategies. First, line asset strategy, which helped them to expand fast by renovating or leasing out the all independent service stations, which take less time and capital expenditure to expand cocoa stations, which are very different from the industry standards. Second, small town strategy, focusing its expansion plan in the upcountry and local road first. This not only helped them to not face its competitors directly, but also slowly building awareness and loyalty among the commercial segment and upcountry customers before entering Bangkok. And this helped PTT to secure its unique position in the market with a commercial segment focus.
Let's move to our first supporting point for a buy recommendation: solid backbone. The two reasons why PTT could maintain its strong performance in the future are: first, oil will still be the major revenue for PTT, and second, transforming to one-stop service station. Oil is still king. There is still a long road ahead for EV adoption in Thailand, especially for commercial segment, which is PTT target customer. The commercial battery electric vehicle will not be available due to the infeasibility of battery range and weight and the lack of mid-road charging station. As a result, we see that oil will still be the major fuel in Thailand for the next 15 years. The oil consumption is driven by the GDP. The rise in GDP then results in an increase in passenger car ownership and a rise in freight transport for commercial segment. This makes the modernization rate to grow by a CAGR of 4.43%. We then forecast that the future proportion for the oil fuel vehicle will be maintained at 91% of total accumulated vehicle. As PTT is well positioned and considered a leading service station in Thailand, it would enjoy the above industry revenue growth of 8% CAGR. Moving on to transforming to one-stop service station, as the PTT Cocoa service station will continue to increase, we see the potential for Pantai and Massmart to expand along with the service station. This could create a one-stop service station and attract more customers. With diversified portfolio to non-energy business, PTT could utilize its PT MaxGuard ecosystem from its touchpoint and benefits from generating a higher margin from the margin accretive non-energy business. As a result, we see the potential for the non-energy revenue to grow by a CAGR of 14%.
Apart from its solid backbone foundation in our retail, PTT also enjoys the new growth drivers in its new line businesses. And these are the new growth drivers: the LPG retail and the diesel business. Even though LPG consumption in Thailand indicates a stagnant industry trend, LPG actually provides a higher and more stable marketing margin, and additionally provide leverage synergies to its core business. LPG can be categorized into two sectors: the automotive sector and the household sector. As for the automotive sector, PTT are replicating its successful light asset strategy and also utilizing its own oil retail station to expand the new LPG stores. On the other side, for the LPG household, PTT could outwin other competitors by running a self-operated model, which gives PTT a competitive advantage of low gas price. Next, the biodiesel, which is purposely used for blending with diesel product. The usage of biodiesel in Thailand is forecasted to grow at 10.4% CAGR, benefiting from the government regulation of replacing the B7 gas to B10 as a new standard diesel mixing. And this will result in a greater customer demand and a higher B100 price. PTT could capture this growth trend through the stable revenue of its own biodiesel value chain, the palm oil complex. and not to mention the high barrier to entry of the industry itself that would make PTT a valuable player in the industry.
And lastly, PTG will get a superior financial performance during the forecast period, thanks to the solid revenue from oil business and positive future prospects, which we will look into two parts. First, PTG net profit margin has increased over time and stay over 1.5% in the forecasted period. Since PTG has entered into the margin accretive business, which generates the gross profit margin over 30% compared with the oil business that generates around 7%. Moreover, the EBITDA from non-energy business has increased from 15% to be around 23% in 2026. This confirms that PTG will generate a better net profit margin and able to sustain value to the investor. Second, PTG will have enough cash flow from operating activity to cover its annual capital expenditure, which is around 4 billion baht. Moreover, PTG can increase the level of debt financing since net debt to equity ratio has decreased to be around 0.31 in 2026. As a result, we see that PTG will have a healthy source of funds to support further investment in the new business.
From a valuation perspective, it confirmed our stock buy recommendation with the target price of 21.75 baht using discounted capital analysis. The target price is derived from 5 main businesses, of which energy business has accounted 59% of the target price in total. For cost of capital, we apply Golden Growth model to obtain the expected market return of 7.85% and 1.18 adjusted beta according to that model, which result in 8.7% cost of equity based on capital asset pricing model. Meanwhile, the cost of debt stands at 6.54%, deriving from the credit spread approach. As a result, we come up with a weighted average cost of capital of 6.92%. We maintain the marketing margin of oil business at 1.9 baht per liter and 2.24 baht per liter for the LPG business. Also, we implement the terminal growth rate of 1.5%, which is based on the expected inflation rate of Thailand. This assumption will also align with our conservative view regarding the ESG risks. Comparing to its peer, PTG's ROE is expected to be the highest, while its forward PE is relatively lower than the mean, which suggests it is undervalued, especially when comparing to the leader OR, which is more expensive. This is also confirmed by the current trading price of 18.4 baht, which is traded at a lower PE band. Therefore, this is the right time to buy PTG.
We identify 6 market businesses, and the biggest threat to PTG's valuation is the higher and faster EV adoption that we anticipated. And this scenario might be driven by the increased government support of the EV cars becoming more affordable for customers. And this will affect our oil station volume growth. However, despite these scenarios, we can see that there is some potential upside to our target price. And this is due to PTG has been reacting and mitigating this trend already, such as investing in EV charging stations or the investment in the non-energy businesses. Regarding to ESG, we are seeing that PTG is stepping to the right direction. And this is because we can see from its initiatives disclosed in its 2019 sustainability report that its initiatives are effective and up to industry standards. However, we see that PTG can still improve in terms of its specific industry KPI disclosures. We can potentially help that attract future flow of funds.
In summary, with the 3 reasons of its solid backbone foundation in oil retail, the new frontier of growth in LPG and biodiesel, and superior financial performance reflecting the future prospect, we have concluded that PTT is indeed a great investment opportunity and best suited with a buy recommendation. Thank you for your attention, and the floor is now open for questions.
All right, excellent presentation. Let me start off by, you mentioned a target debt to equity ratio of 0.52 and a weighted average cost of capital of 6.9. What I'm concerned about is that you may be using the debt structure that the company has today to value this company to infinity, when in fact, the debt structure may actually be falling, right? So just explain to me how you got this weighted average cost of capital, because if you're wrong, and it's not 6.9, it's more like 8 or 9 or something like that, how does that affect the price or the value that you calculate?
So let me clarify your question. So you're wondering how we come up with a different target debt ratio from the weighted average cost of capital, right?
Yeah, right here you have 54% in debt. So you have more debt than equity. No company is going to exist forever like that. So my question is, I'm afraid that your WACC is actually too low. What would happen if we raise that WACC to 8 or 9%? Do you have a sensitivity on that?
First of all, for the target debt ratio of 52%, we look at the historical debt ratio of the company during the five-year historical data, which is the rapid expansion for the PTG, and PTG could still service such level of debt. So we believe that implementing the 52% debt ratio is appropriate because as in our forecasted period, as PTG is diversifying into the non-energy business, which is a margin accretive, this would help the PTG EBITDA to be higher.
But if we go ahead 1 year or 2 years, your debt to equity is falling. We value the company again at that time. Your WACC is not going to be 6.9. It's going to be higher because you have less debt, I believe. But yeah, go ahead.
Yes, so with the increase in WACC, it would definitely lower our target price, and we can see, however, it still have a potential upside to an increase in WACC.
Yeah, it actually is also about your DE ratio. In one of your slides, you show that net DE is actually 1 time something. So that is drastically different from the other teams and also from the financial statement as well. Can you explain it to me? Why is it 1.09 times? Have you incorporated the impact from the IFRS 16 into this?
Actually, we didn't incorporate the IFRS 16, but what we see is that we use the current net debt, which is the interest-bearing debt that PTG has from the debentures and also the financial institution loan.
And let me add on to my colleagues, because we have researched that the implication of IFRS 16 might not have the long-term effect on the evaluation, but in the kind of like short term, as this adoption is quite complicated, it might reflect into the valuation that we calculate. Therefore, we want to minimize those kind of complicated effects in order to avoid this, avoid maybe the miscalculated of the price.
Okay, got it. Actually, I'm just gonna follow on another question. It's about the non-oil, right? So if you compare it to the OR, they use the landlord models, right? They don't do it themselves. They don't do PTT Mart, right? They lease it to 7-Elevens, right? So why do you think PTG with do it DIY models, do it by yourself models, it's going to be more efficient, better than the landlord models?
So first of all, thank you for your question. So the reason that PTG is mainly utilizing the self-operated model because we will receive a higher margin based on that. And the second thing is that our objective for PT MaxMat is not to attract more customers to enter to PTG, but instead to serve the current customer that PTG is having, which is the commercial segment. That's why it's better for us to have a higher margin, but still be able to maintain and satisfy our current target group.
You have an oil CAGR of 8%, and I think you're increasing market share, which implies that you're taking market share from other players, given that it's concentrated. What is it about the company again, which is making it able to do this?
Okay, so first of all, since PTG is expanding in terms of the independence by acquiring the independent service stations, it is able to capture a lot of the independent retail market share, which is still available in the market right now. So could you go to slide of the total number of oil service stations in Thailand? So as you can see, the independent players in Thailand, there is around 20,000 of the overall market. That means PTG can still utilize its light asset strategy to really expand faster than its competitors who usually expand by the dealer's own dealer-operated model.
Can you go back to your first slide, the first slide? You have 3 points that you highlighted in this whole story. And this new frontier of growth, I'm a little bit nervous that this is not that critical. How significant is LPG and biodiesel to the overall value? Let's say your target price is 21.75. what percent or what amount of that price is coming from that area?
For the LPG business, it's accounted around the 3 baht, and for the biodiesel diesel, we incorporate it into the oil and other, which is around 3 baht as well for the biodiesel from the PTT green company.
So you feel it is this a significant element?
Yes.
Okay.
Yeah, speak with this patient first. In my view, you're quite bullish on the Pan-Thai business, given that you value 4 baht for the company. Can you elaborate on this valuation?
So we apply the SSG of Pan-Thai to be 1.4% to align with our conservative view, and with only 1.42% SSG, the top line revenue growth of Pan-Thai is actually high at 14% CAGR.
And that ability is achieved by having still a lower number of Pan-Thais within the in the PTG service stations. We have a lot of room to expand, even in PTG service station, as we are now reaching the number 2 and number 1 of Thailand. Therefore, we see that the most of the growth driven will be by the store expansion plan.
How aggressive of the store expansion?
Could you go to the
The store expansion is, we forecasted 50 stores per year within the service station, and we see it is a necessity for becoming the one-stop service station.
Only 15?
50.
Or 16,
Can you go to slide 25? So the EV impact to the sales per stations, right? I noticed one thing, maybe I don't fully understand that. Yeah, this one, that table on the bottom left. So impact on the current rate, EV utilization rate highest minus 100%. Your target price is still 16 baht. What does that mean? You mean if everyone is using EV, nobody is using diesel and gasoline anymore, the target price is still going to be 16 baht?
So actually, to clarify your question, to clarify our slides here, so the impact on the current rate is actually on the current rate of the oil volume growth per station. So it means that our forecast is that if there is no even oil growth due to people switching to the PTT to the EV adoption for the passenger segment, we see that there will be no growth in terms of oil volume growth per station in the period at all. So that's why it leads to the 16.44.
Actually, I have another question on the non-oil. So you mentioned that they are running their own. Obviously there's a huge contribution coming from Maxmart and Pan-Thai. That's 5 baht, more than 5 baht, right? So what makes you think they can run, a coffee chain better than the professionals operators or professional operators of the convenience stores like Family Mart, Lawson? What was the differentiating point here?
As making its by DIY, it would make the PTG to generate a higher margin for Pan-Thai and Maxmart. And with our news that we have known that Pan-Thai is going to blend its hemp with its food and beverage, which is like the new strategy for Pan-Thai, who we differentiate and maybe has a potential to go outside the service station.
And for Maxmart, we believe that the main unique advantage will be the Max Card, which is the ecosystem that convinces people to utilize their points that they receive, which is we giving points to every leader despite of the types of the fuel that they are refueling, which is very different from
Time is up for Q&A session.
Please stay for the feedback.
Okay, I'll kickstart this. I think the presentation is good, the timing is good, slide quality is okay, it's good. But one thing though, you open your presentation with the first slide, right? Go back to the first slide. And that slide basically addressed the EV issue, right? Now the problem is the way you address the EV issue is that battery is not good enough, longevity of the battery is not, I suggest you be extra careful with that because the R&D in this field is extremely fast moving, right? That is a big statement that, over the next 3 years or the next 5 years, battery will still not be good enough for the mass EV adoption. Many people has been wrong about that, right? So that's the first point. The second point is about your last answer, your answer to the last question, which is about the hemp, right? That is, I think there's some development going on with the company right now, right? But if you were to get to represent in the regional round, be extra careful with that because what you're saying that is that you're gonna mix hemp, right? Into the coffee or into the product that you sell in the gas stations, and your main client is basically a truck driver or a pickup truck. These are drivers, right? They drink your product and go back on the road. So be extra careful with that, right?
A few things. I think, first of all, I like, when you talked about risk, I like the fact that you focused in on kind of what's the primary one, and that you talked a little bit about the negative, and that's important because, we're trying to understand. You can see that I was honing in on the weighted average cost of capital concept. I'm afraid that when we look at valuing a company that's highly leveraged, sometimes it's like a distressed company, and the capital structure can change very quickly over the next, let's say, 3 years. So the question is, do you use the capital structure that the company has right now, or do you set some target capital structure that's farther out in the future? I would say that you set some target capital structure. If that was the case, your WACC would be a bit low, and that could bring down, and that's what I was asking about. So there's a vulnerability. It's not only yours, the other team had a similar vulnerability. Also, unfortunately, I couldn't read some of your slides. I just couldn't read some of the charts, so that hurts. The last one that I just want to mention about is this, the accounting change. And when he asked you about the accounting change, you said you didn't include it in your numbers, right? And he accepted that answer pretty well. And I think that in fact, I would say you answered it right in the sense that, remember, accounting is just a lot of rules. But when we value companies, we value them based on economic value. So the market participants, yeah, accounting rules will sometimes cause some small changes, but over the long run. So I just want to commend you for that answer.
Thank you so much.
Just some comments just on the presentation, generally quite good. Just some ways to make it better. At the end, you closed on a summary slide. Good to go through again what are the key drivers, like what you say at the beginning. You have a minute and a half to go in your presentation. You can spend some time just to reinforce your message. The second point, on the flip side to what the comment about EV, similarly, it's more on the oil. Your view on oil is that for the next 15 years, oil is still king. That's a bold statement. Again, just be careful because some people can see it a different way and can challenge you. Again, it's very difficult to forecast issues like this, along with Thai baht and oil prices. Be careful.
Yeah, thank you for a very good presentation. Yeah, again, I think you focus time. But the good thing for your team is that you have an implication for the higher ESG score, which is draw more control. Yes, that's good. Thank you.
Thank you so much.
Thank you, the judges, for your feedback, and thank you, Team D, for your presentations. Now, our team have finished the presentations, and we're going to finalize the total score received from the judges, and we will resume again around 11:25 or 11:30 for the winner announcement and award ceremony. Thank you.